inflationary pressures have continued to abate for the fourth successive month. Annual headline and core inflation declined 25.4% and 26.3% respectively in February 2012 from 25.7% and 28.1% in January 2012. Annual non-food inflation also fell to 23.8% in February 2012 from 24.2% in January 2012. The February inflation was 25.4%, which was almost identical to that of January of 25.7%. The slower decline in inflation is attributed to the big jump in fresh food crops prices, which I believe is very temporary. Monthly food crop inflation was 7.3% in February compared to the decline of 3% in January 2012. Rising food prices and the recent increase in power tariffs will keep inflation elevated, especially in the first half of 2012. But these stresses will be partly offset by softer domestic spending and excess production capacity in the economy. The softening of domestic demand, together with the deceleration in global inflation, is likely to contribute to lower inflation going forward. Overall, the downward trend in inflation observed in the previous 4 months will continue. And I expect headline inflation to move lower again as the current trends reverse fresh food prices. Bank of Uganda expects no reversal of the disinflationary trend or a build-up in inflationary pressure in the months ahead. And I fully expect inflation to be in single digits by the end of the year, whatever the doomsayers may say. The global economic growth for 2012 has been revised downwards, and uncertainty on the outlook remains elevated. Europe remains the major source of this global uncertainty, while the likelihood of another global recession seems to have lessened a little recently. If it did occur, it will spill over into Ugandan economy through trade, financial, and confidence linkages. The global slowdown is likely to put more pressure on Uganda's balance of payments and income from commodity exports. Remittances from migrant workers, trade volumes, and foreign direct investment could decline significantly as a result of the subdued global economic growth. This could put more pressure on the exchange rate, but equally also on domestic aggregate demand. The Bank of Uganda believes that while inflation is still high, the disinflation momentum is likely to be much faster than previously expected, as reflected in the trend of monetary aggregates. The annual growth rate of M3 decreased 6% in January 2012 from 30% at the beginning of the financial year of 2011-2012, reflecting a sharp decline in monetary aggregates. The annual growth rates of loans to private sector also declined in January 2012 and stood at 23.5% from 45% at the beginning of the financial year 2011-2012. This drastic reduction would result in an unwarranted sharp contraction of economic activity in the months ahead. Therefore, a cautious easing of monetary policy is appropriate, given that over the period ahead, inflation is expected to decline much faster, and given that economic growth is expected to remain subdued. In line with these developments, Bank of Uganda will reduce the CBR by 1 percentage point to 21% in March 2012 from 22% currently. The band on CBR remains at plus or minus 3 percentage points, and the margin on the rediscount rate remains at 4 percentage points on the CBR. The rediscount rate and the bank rate will therefore fall by 1 percentage point to 25 and 26% respectively. The rediscount rate and the bank rate will therefore fall by 1 percentage point, 25% and 26% respectively. Looking ahead, Bank of Uganda will continue to conduct prudent monetary policy to bring inflation down closer to 5% over the medium term, and also to ensure a firm anchoring of inflationary expectations in line with Bank of Uganda's aim of maintaining price stability. Such an anchoring of inflationary expectation is a prerequisite for monetary policy to make its contribution supporting economic growth.